Hi, my name's George Henderson. I work on the Harbour fixed interest team. I'm responsible for the Harbour Enhanced Cash Fund. Today we're here to talk about term deposits, why we like them and why we don't like them, and how we manage those for clients. So what do we like about term deposits? Well, term deposits can offer a higher interest rate than other cash market instruments. This premium sometimes means it's worthwhile to lock up the funds for 6 or 12 months and deliver a higher return to clients. So what don't we like about term deposits? Well, they're not very flexible. We've locked that money up for 6 or 12 months, and if better opportunities come along, we can't get that money to access those better opportunities. And sometimes that premium is not very good, and actually there are better alternative instruments out there, and we've seen that during this rapid rise in interest rates over the past few years. Term deposit rates have lagged, and we've sold out or reduced our exposure in our fund entirely, and we've been looking to wholesale cash markets to invest. So why do term deposits move? Well, the biggest driver is the RBNZ. They lift the official cash rate, and all cash market instruments get higher in return. Banks, however, do pay a premium to access term deposits. They like that stickiness, or knowing that the funds are sitting with them for 6 to 12 months. That premium they're prepared to pay ebbs and flows. Banks are profit-making institutions. Ideally, they don't want to pay away excess return. When they need money, when the housing market is booming and there's lots of investment going into there, the banks need funding and they're prepared to pay a higher premium. So in a case where the interest rates rise quickly, housing market's a bit slow, then that premium can get squeezed in, and that's what's happened over COVID. So what have we been doing in funds? Well, term deposits can make up a significant part of the investment we have in our Harbour Enhanced Cash Fund. We have held up to 1/3 of the fund in term deposits in periods prior to COVID. However, we've let that term deposit exposure run down to zero, and it's been non-existent for much of last year. We've seen much better opportunities in wholesale cash markets and also other short-term debt instruments that banks issue. Currently, we're investing some money back into term deposits, but those premiums just still remain a little compressed and not that attractive compared to some of the opportunities we're seeing elsewhere in cash space. When we see the rates offered to mums and dads when they enter a main street bank, those rates don't look very attractive to us at all, especially when we see what the banks are offering on the wholesale markets. Now, tax is a really important consideration as well. Higher interest rates mean higher returns, and that tax drag has been increasing. When an investor puts a term deposit on straight with the bank, they're subject to their personal tax rate. If an investor places money in a PI, they're subject to those PI tax rates, and those tax rates can be lower. So for some investors, it's more tax efficient to be investing in a fund that invests in term deposits rather than going directly themselves. So where do we currently sit with term deposits? They're okay. The premiums are a little compressed. We're starting to rebuild positions within funds. We're very conscious of those after-tax returns for our end investors, but we do see a lot of great opportunities in wholesale cash markets and other short-term debt instruments issued by banks.